Okay, might press record this time. So yeah, guys, I ran the session last week, forgot to record it. So anyway, we are back. All right, sorry, one more check, because I want to double check they can hear me. Please type it into the chat. We are going to go and run this as an interactive session, so I'm going to run through some of the basics. Perfect, thanks, Ivan. Still so weird seeing another Ivan there, but anyway. So guys, we're going to run through a bunch of stuff today. Thank you for making the time. We're going to be talking about trading systems. We're going to be talking about trading strategies, and really how to position your book for today's markets. And yes, this time I am recording, so if anybody wants a replay, I can actually honestly give it to them. If you were here at the last week's session, if you've got any questions, take that as a refresher. Otherwise, yeah, you're going to sort of see similar information to last time. Any advice contained in this presentation is general advice only. So when you're dealing with options, we sort of spoke about some strategies last week. That were 2 weeks ago now, that were on the safer side, so cash secured puts, covered calls, things you can do to improve the overall portfolio. If you want to get access to that and haven't had that yet, the guys can send it through to you. These strategies are a lot more, the risk reward is different on these strategies. They're still limited risk. They're not sort of the well advertised, you will win money 80% of the time when you're going and trading, but options do carry risk, and you need to make sure that you understand what you're doing. We've got simulated accounts, we've got heaps of education to go on and help you on the journey, but please don't jump in there and start doing crazy things with options, because it may not end up as well as you would believe. For those of you that are new, we've got a couple of people who I don't think have joined before, so welcome. But our background is we've been in the option space, in particularly focusing around Australia and risk management systems for a bit over 10 years now as a team. So we've done a bunch of stuff. Our systems are still used everywhere in the market, and we've mentored a lot of advisors over the years in terms of how to go and better position their books. I think we've contributed a fair bit over the last 10 years to de-risking a big chunk of options in the market. So sort of there's blow-ups that used to exist. I think our systems have done a lot of work to stop people from doing that. We went into retail. A direct to retail offering in 2016, which was initially called Trade On and then implied Volatility. And then about a year ago now, I ended up buying that business with my co-founder and growing that since. So that is now Volatility, brand new technology, and we decided that we want to go on and continue powering the option space in Australia. I mentioned me and my co-founder have been together since 2014 in physical business. We met at the previous company, GBST, back in 2012, 2013. I think it's been a long time. He looks younger, I look older. And we've had a pretty successful time running businesses. This is starting to grow now. We've got 8 in the team, so you'll meet guys. Tom's on around today, too busy racing, but Blake's on the call. So if you've got any questions, Tom and Blake are always on the chat. They've both been active traders. Don't let their age fool you. That, for example, Blake's strategy is a broken wing butterfly. Still don't know what that is. I've got some ideas, okay. But they've been around for a while. They've been around options for a long time and other derivative products, and they essentially help that entire onboarding and customer service area. They're going to be doing a lot more in the platform as time goes on, so watch this space. When you're coming and trading with us, we've got quite an interesting, and to some extent watch this space, but we really have always focused at the top end of the trading community. We don't offer CFDs, we don't run B-books. We only offer equities, ETFs, and options. At the moment in Australia only, and there's a clear plan to move to US as well in the not too distant future, and start offering that as an additional product. But not a lot of people trade options in Australia, and the people that do are typically either fund managers, institutional traders, or slightly more sophisticated end of town. So when you're coming and trading with us, and we hope to we've had a lot of feedback around building on a community element, but when you're coming in and trade, well, not even just becoming a subscriber of the platform, not necessarily even trading with us, we are a completely DMA solution. We're completely transparent. So our goal is for you to go in and become a bigger client, and that you can only do that through making money. So we run a lot of education to help you on that journey. When you're opening up an account with us, it's your own kin. It's CHESS sponsored by Morrison's, which is the largest wholesale broker in Australia. The cash sits in your Macquarie account, so you collect all the interest. You have full control of your cash. So we really believe in transparency. And the third thing that we believe in is innovation and really leveraging on our experience. I think we've got one of the best options desks from an experience point of view in the country. We definitely have the best technology in the market for this, and we pride ourselves on the customer experience element, as well as then having those conversations with people who understand what you're talking about, and then tying that back into building a better product, as you would have seen. Right, in this session, as I said earlier, and for those of you that have sort of just jumped on after, but if you want to have if you have any questions, please drop them in. I will go in and answer those. You can either drop them to the comments section, or there is a Q&A section. So both are fine. I will answer them as we go through. But basically, this session is really all about getting I guess the positions right for these kind of markets that exist. And as I've worked with, as I mentioned, I've worked with a lot of advisors who specialize in options, and sort of the two biggest mistakes that I see them do is, one is they either make their portfolios overly complicated, so they sort of end up kind of creating almost market maker positions, which becomes really difficult to manage. There's sort of a handful of strategies that allow you to have a wide variety of options, and it makes sense. But if you do that too much, then you pay too much in fees. You end up having, you have a significantly more difficult book to manage. We really have always preached that you should have a view on a market. You should take that view on the market if you believe that the odds are stacking up in your direction. And make sure you stick to that view. So you may need to repair, you need to do whatever, but don't sort of end up creating other alternative strategies in the process, just because the view didn't work out in the way that you expect. The second most common thing that I see in the market is, and this has become a lot better, but still to some extent, as we've started working with advisors again, excuse me, we're starting to see the sort of this disrespect towards volatility. And we initially thought volatility is obviously important because we call our old platform implied volatility. We thought, you know what, it's not just implied volatility that you should be worried about. You should also be talking about historical volatility as it relates to your equity portfolios. And so there is a big push on our side to go in and say, well, we've given a lot of tools that don't exist anywhere else in the market to go in and clearly see where implied volatility is and volatility is for a particular stock. It's very important to pay attention to that when you're trading options, and it's also an extremely valuable indicator to pay attention to when you're trading equities too. So in this session, we're going to go through, in particular, focus on the breakout trade strategy. So it's called LIT, Leading Indicator Trend Trading System. And the Leading Indicator Trend Trading System is all about implied volatility and a breakout. And so typically, and I just mentioned this in email that you guys would have clicked through, it's that we have a natural predisposition to not want to buy the highs of a market. And you go think, oh, it's trading at 52-week highs or all-time highs. I cannot bring myself to buy it. And the reality is that there's two things to consider. One is, when you're trading equities, chances are if the stock is trading at all-time highs, it's breached all-time highs a long time ago. In Australia, we have a massive culture of franking credits that are paid out. As a result of that, the amount of stocks that have went through the all-time highs is quite high. So it may not seem it, but because of the amount of dividends that companies are, at least good companies, are pushing out, you're on a total return basis, we're probably already trading at all-time highs. Then comes a psychological barrier, and that psychological barrier is, well, and by the way, everyone faces this, including myself. It's like, well, why should a stock be so high from a price point of view? And historically, and now it's a slightly different reason because of the environment we're in, but historically, when a stock is trading at 52-week highs, it's actually trading at the cheapest point in its life, because you essentially get sellers coming through and pushing the price down. But fundamentally, there's typically something that's shifted, which is causing institutional traders to go on and buy up that stock. It's like fund managers accumulating, etc. So we're going to talk about the current conditions. We're going to be focusing on the 52-week highs that exist in a lot of stocks, and how to basically get long the market and make money if it fails. And sort of the conditions when not to do it as well. And we're also going to talk about sort of picking that direction and looking at a sideways strategy as well, and sort of how trade ideas fit into all of this. And as I said, if you've got any questions, just drop them in. I'll get to them as we go through, no matter how silly you think they are. So we're going to talk about iron condos for the sideways trading. We're going to talk about lits in particular on the breakouts to the upside. We're going to look at a few live examples. And if you don't have an account yet and you want to practice them, sign up for a free trial, and you get 50K practice account as well. So, all right, let's do a quick refresher for the new guys in the room. Who uses options? So typically, the biggest user of these are fund managers. You now see a lot more, even ETFs are starting to run overlays with options, typically focusing around the strategies that I spoke through a couple of weeks ago, around covered calls, cash secured puts. And the kind of most common way of doing that is using options instead of using limit orders to go in and get paid by the market. You get institutional investors and traders and private traders and investors. In Australia, options are generally relatively hard to get access to, and as a result, so like no neo brokers, for example, as they're called, offer them. There's a little bit of a risk evasion from the providers, the clearers of options. And as a result, Australia is nowhere near in a position like, say, US, which is, everyone trades options over there. At one point in time, the options market exceeded the equity market in terms of notional volume traded, and so that it's a globally very popular tool. Having said that, in Australia, we don't have that ease of access to exchange traded options, and as a result, it is much more in a sophisticated end of town that they're used. And typically the people that use them to go and increase income. They use them to protect the portfolio from downside, and as I said, to buy shares at lower prices, sell shares at higher prices. So they're probably the most common strategies you see, to go in and go, okay, I've got a stock, I feel like I want to be out of the stock at a particular level. Instead of putting a sell order in, the market will pay you to do that if you use options. We like options. Going back to the transparency element, we like it because it's an ASIC, an ASX regulated product. It's massively regulated. It's not, obviously everyone is regulated from the sake of offering advice like a CFD provider, but these are properly regulated, reviewed. They're all exactly the same. When you're trading in the market, you're trading in the market against other people. It's a marketplace. It's a stock market, just like you do have with equities. There's no one in the middle that sits there, kind of pretends like there is a market there to then go on and sell off order flow into different places. So in Australia, it's an extremely sort of conflict-free market, if you will, and the only participants you have in the middle are market makers, and market makers provide liquidity and they're there to also participate in profit, but they typically trade a completely different dimension to what portfolio traders do. So the other thing that we sort of like a lot with them is that you don't sort of, you use them with your equity portfolio, so it's not a one or the other, and you don't have to always have a trend in the market to make money, which is most of the time stock goes nowhere. Two of the most famous people you would come across, or at least two of my favorites, and for very different reasons. I've always been a fan of Paul Tudor Jones. His fantastic track record in the hedge fund space. He uses a lot of futures, a lot of derivatives, and a lot of options. And he is also one of the most risk-averse people you'll see in the market. Always about surviving the next day. But if you ever want to read some interesting interviews with traders, he's definitely an interesting one to read. Very interesting perspectives on the market over his very long and extinguished career. Warren Buffett is the one that you probably don't know about, because when Warren Buffett talks about derivatives, he typically talks about weapons of mass destruction kind of for portfolios. So having said that, one of the most famous trades that he's done with options is the Coca-Cola trade. Again, it's a trade that you'll see that we spoke about last time, which is cash secured put. I want to buy the stock. I want the stock to drop. I feel like it's too expensive. He did this with Coca-Cola. And he sat on the trade for 6 or 9 months or whatever it was, collected a lot of money from the market, thought Coca-Cola was too expensive, ended up using options to accumulate his position, and it turned out to be a relatively stealthy accumulation, if you will, because no one sort of knew, they didn't see him coming. Immediately became a major shareholder, and then he continued growing that portfolio or that position for a long time. Sure drinks a lot of Coca-Cola, so why not buy it? Options, going back to the simplicity and the complexity of options, this is where before people sort of jump ahead, there's really only 2 options in everything that you do, and by the end of the session you'll know how to do most of it already. It's always a combination of these 2 options. So you're either buying and selling combinations of calls and puts, and or puts I should say, and quite simply, if you're buying a call option, you're expecting the stock market will go up. If you're buying a put option, the stock market will go down, or the underlying share price. So conversely, if you're selling a call option, if you own the stock and you're selling a call option, you're expecting that you want to sell that stock if the price goes up. So you're sort of, it could be using a call option for moderately bearish reasons as well. But let's jump into trading systems. And this is really where a lot of the focus will lie. And everybody who I've seen who is a successful trader has got a very clear trading system. And albeit that the first part of the trading system is really like, again, starting a business without a business plan, the importance of a trading system is much more than just that. So the trading system is something that you will be using as your basis for forming your opinions when things aren't going your way. And sometimes holding you back when things are going your way a lot. So business is sort of exactly the same thing. There are people who come into the market and start a business, and I've consulted to a lot of businesses over the last couple of years that have been very much detached from the reality of where their business is. So they think they're untouchable, they think they're really good. Instead of focusing on the numbers and understanding that there's a short-term blip, they get overly confident and start making silly decisions. Conversely, sometimes things just don't work out that you plan for. Sometimes you're not getting enough foot traffic through the door, or something outside of your control might be happening. The market might be giving you something slightly different than what you've anticipated, and so having a trading plan is exactly like a business plan in that sense. You need that to form your decisions and make sure that you're reviewing it regularly, and that you use that as a way to, continue believing in downtimes, and also not getting too way ahead, which is way more worse than not believing in yourself. Getting overly ahead of yourself is way worse in trading than it is to not believe in yourself. And I've been on both sides of that as well, which is why I've got a trading system too. The basis of what we will talk about, and again, we'll show you a step-by-step trading system. This trading system has been used by our clients almost from, might be 2000 to 2017, 2018, we published the lit trading system in the first place. And we've had clients use this continuously. And so what we've noticed is that people will typically take the base rules of what we've given for both breakouts and sideways. Well, sideways is a little bit different, as there's a there's an algorithm behind the scenes that learns from the market. But for breakouts, there's a very simple rule-based formula, which I'll show you in a second. And you can also, if you want to get like a PDF with the rules, just let us know in the chat, or either in the webinar chat or in the platform, just in Volatility, in the bottom right-hand corner, you can just chat to us and we'll send it over to you. But a lot of the guys that have used this trading system have really used it as a base and then adjusted it to suit their requirements and suit their personal psyche and how they want to trade. So this system is a bit of a swing trading system. It will go for, your average hold time's probably about 45 days, sometimes a bit longer. Whereas in reality, you might want to be trading on 1 day increments, 3 day increments, or you might want to be looking much longer term, 6 month kind of increments. So we sort of, with options, 45 days is a very kind of is a sort of a bit of a golden number. A lot of back testing that we've done seems to come back to that is the optimal time of decay in the option versus sort of outcomes and lowest point of volatility in return for bang for buck, basically. But let's start with breakouts. And basically a breakout is going to be looking at a combination of different things. We, by base definition, look at 52-week highs and lows as our purposes because we know that the entire market's looking for that. However, if you're looking to be a little bit more active in the market and you're looking to have more buy signals, you could look at much shorter periods of time. You could look at 30-day periods, for example, 90-day periods, 20-minute periods. So the first thing to I guess the things that we use to go and identify a breakout is a combination of support and resistance. So is there a level that if we can see the market going through confidently, that we know that there is a real breakout there? It's a breakout with momentum. We also use average directional index. ADX is built by the same guy that did the RSI and pivot points and a bunch of other indicators. It's sort of the one that he's most proud of. Mathematically relatively complicated. You can just add that as an indicator to your chart, or add that as a in your watch list. You can add that as an extra filter when you're filtering for stocks. But the ADX is a trend based. Is there a trend or is there no trend in the market? We use moving averages. So the one that is the most commonly used in the market is a 50-day EMA over a 200 EMA, which shows you whether there's a golden cross or a death cross, i.e., is the underlying stock in a bullish trend or a bearish trend. And we use candlesticks, and candlesticks is something that I think that's been around forever. Love them or hate them, they give you a lot more information on the chart around where the highs are, and you can probably identify some patterns as well. At the end of the day, when you're trading anything, one thing to note about technical indicators, you can go very hard with adding lots and lots of indicators to your chart, which is how I also started. But in reality, all you're trying to go and understand is the supply and demand for the current underlying asset. And most of the supply is going to come from, typically in a bullish breakout, most of the supply comes from non-sophisticated traders, and most of the buy side during a breakout is going to come from institutional investors. So your demand far exceeds the supply. The trick is to understanding when it's real and when it's not driven by retail traders trying to get access to low liquidity kind of environments, low volume environments, and it's just sort of a combination of different things. And that is the big thing. Technical indicators basically help you understand what's going on in the market. I've been trained quite a lot on as a trader on actually watching the depth, so watching people come and put through orders. And that's probably the most true indicator you can get. But in terms of, there's no point going and adding 100 different indicators to your trading system, because most of them do kind of the same thing, and they're all a little bit in the past, right? Moving average is a good example of this. In the case of lit, we focus on a handful of things. One is is the market broken out from its 52-week high or low on the downside? Focus on the upside. Is it breaking up on the upside? In that case, okay, is it doing it with volume, and what does the price action look like? We look at implied volatility as a good indicator of that as well, as another extra filter to go and understand, is there uncertainty? Is the market behind the move? Is there complacency? Is there a bit too much greed? And we look at a 30 to 60-day period. So we think that through all the testing we've done, around that 45-day period, you're ultimately selling a spread. You really want that to, I think we had a perfect example of this, and I suspect it's going to play out in the way that I'm expecting. GMG is a really good example. GMG's been rallying. We've had a lit long on that for 3 months now, from November or whatever it was. It just keeps going, and eventually it's going to break down, and chances are it's going to break down aggressively, which is exactly what this trading system is designed to do. It's meant to sit there on the 52-week highs, continue collecting your maximum profit or close to maximum profit as it continues going up, eventually runs out of steam and crashes. Where this system goes badly is where it runs out of steam and then goes sideways. And if it goes sideways, that's where you get a little bit stuck, and that's where you start getting into sort of repair mechanisms, and you need to have some rules for yourself around when you stop. But typically, the lit system is all about trend trading and trading in the right direction, and completely repairing your strategy when things go wrong. So rules are really simple. Is a 50-day above the 200-day moving average? Yes. Is a share price above the 50-day moving average? You can almost skip that one because it's almost always going to be that way. It's very rare to have a 52-week breakout with the moving average being below it. Something's clearly wrong if it's not there. The next thing is the 50-day moving average trending upwards? Great. You typically will during breakout scenarios. Sometimes it doesn't, and that's a very, very bad signal, i.e. it's been lurking around the 52-week high, then it kind of just breaks out and then it comes down. Yeah, that trending upwards element is quite important. You want to have that momentum of the last 50 days really behind you. Is the share price above the 52-week high? So it's your 52-week breakout. Is the ADX above 20? Yes. With the share price above the 52-week high, this is one of those. The reason why it's sort of a little bit down the track is that we have had people who've wanted to go in and reduce that period to say 90 days, and they just want to trade short-term breakouts. I.e., if you've got something that's been sideways, you might want to be in a little long way earlier before it goes to 52-week highs, and there's some really profitable trades. It also just depends as to how you want to go and run your book, and that's why practicing these strategies is very useful before going and doing it for real. If all of that lines up, you go lit long. If someone that does not line up, you don't do anything. And then you keep looking at it. Is the share price still above the 50-day moving average? Are we lower than the resistance just before entry? So this is quite an important one. Basically, if the stock price goes up, falls back down, you don't want to get out too early. So you want to be looking at a resistance. So where did the breakout originally occur? If the resistance is being breached, and it now there's an old saying around trading, rule I should say. As soon as the resistance gets broken, it typically becomes support, and typically all of that happens around a very round number. So 50, for example. The stock might get up to $50. There's a psychological level. The sell is sitting at $50. Once it breaks out, those people are starting to kind of try and scratch their positions. If they were getting short, so they're trying to buy it back at 50, continues. Now, if it breaches that lower support or the lower resistance, i.e. now support, then you need to close that sold put. The repair position essentially then is you are in a long put. So a put option then basically turns into a bearish position, and then you're expecting the market to drop down. When you're in a long put, the thing to sort of worry about there is that you're sort of at that point in time you're okay. You're slightly losing on this trade because you sort of the breakout happened, you bought it, come back down, so it's not quite where you want it to be. At that point in time, you need to be quite. You need to watch the fact that there is now time decay is going against you. So you need that collapse to happen. You need it to happen quickly and aggressively. Most of the time it does, but you need to keep monitoring. So if it's kind of broken down, it's hanging around, and you can see that it's fading out, then you need to start thinking about closing that position. If it starts pushing back up, then you actually end up selling the put again. So you're looking at a recent high. So typically we'll look at 5 days, 5 trading days. And as soon as the share price goes back above the 5 trading days, so it tried to take out its week longs, and then it goes and frequently it just kind of, it's fine at that point in time. Sometimes what will happen though is it'll kind of start going up. You can see it's run out of steam, and then it starts pushing back down. And that point in time, that's really when most of those big moves happen. The strategy will make most of its money on the repair. So if you're just getting into the longs and the market's pushing up, you will be making money relatively consistently. So, it's typically it's going to come out to be, for every $1,000 worth of risk, it's going to be a little bit more in terms of profit. So call it 1.3, 1.4, 1.5, depending on where implied volatility is. So you're going to be receiving a little bit more than you're risking. As soon as you alter that position and get into a long put, at that point in time, you're essentially have uncapped profit potential. If the stock goes nowhere, you will end up losing probably more than what your initial maximum loss was. So it'll depend on what your bought positions premium is at the time of you doing that trade. So just make sure that you're looking at the risk profile at the time that you're doing it. The general thing to say is make sure you don't overtrade. These are highly profitable positions. When you get them right, the probability of profit is statistically on your side, although at the point of entry it's going to be slightly against you, because you're hopefully buying into a moving trend, but just monitor that risk. So with the disclaimer. All right, so let's have a look at this in action. So when you're going and trading it, if you're trading it through our platform, just go a lit long. If you're trading it elsewhere, then it's essentially sold spread. There's a couple of rules around where you get it, but you can sort of tweak that. But basically, here's a chart. It breaks through the 52-week high. It breaks through that resistance. You can see the 50 days is the red line, shorter term. It's moving up. As it moves up, you've broken through. There's basically a buy signal there. So you go tick, 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 fantastic. 50 days above moving. 50 day is above the 200-day moving average. So probably that happens around about there. You get long. You can see it's higher highs. It ticks a lot of boxes. Sorry, I will one day learn to use my mouse. The other thing you're looking for is just the ADX, which we don't have on there, but basically is the ADX above 20. The ADX above 20 is an additional filter you can have, and I keep it on for my trading. It essentially filters out stocks that are not trending. So if the trend isn't strong, you really want to have an ADX confirming a 52-week breakout. So just a general FYI, I think it's a very useful indicator to have on your chart. All right, so basically you're long, then your sell signal comes around about here or here. But basically you're saying, okay, did it break down below the 50-day moving average? The reason why there is a bit of a disagreement around where you would be doing it, and the result more often than not is the same. You typically want to be watching it. You want to have the 50-day moving average turn direction as well. So you'd have some people get out there and keep it, and basically as soon as it gets through there, you'd be buying back again, and you end up re-entering on that short there again. But you're looking at the resistance line. Where do you get long? And then you end up going into a short position around about here when it breaks through, and then you end up capitalizing on the move as it goes down. So you're turning bearish as soon as it gets through. Overall, by the way, just so you know, it's very rare. This was the index, and there was a lot of stuff happening during the time that the screenshot was taken. Basically, most of the time, especially in the modern world, things tend to trend a lot more than they used to be, and there's a lot less choppiness that exists. There's a fair bit of choppiness in these markets at that point in time. Thus, we picked an example that would be slightly more complicated to understand, but there's if you go through your charts and you just put a 50-day, 200-day moving average, you'll see that typically as the stock price goes up, that kind of move will be a lot more smoother, and it's very rare for it to sort of have an aggressive breakdown unless you're looking at something like COVID. All right, we'll quickly look at the bearish view, but essentially it's just a complete reverse of that. If the 50-day is below the 200-day moving average, you're looking at the 50-day trending downwards. Is the share price below the 52-week low? Is the ADX above 20? So again, is there a trend? ADX is a non-directional indicator. It's only a trend, a trend filter, if you will. So if there is a trend and it's an aggressive trend, the ADX goes up. But basically, if all of that aligns up, then go let short. And the monitoring is the same thing. Have you just went back over the support? Has the stock corrected? If so, you close your sold call, and then basically you're in a long call waiting for the market to go up. And then you're looking for the same thing: 5-day period, lower lows, and back into it. All right. Now let's look at the other side of this, which is the picking of direction, the sideways strategy. And the sideways strategy, this is sort of the strategy I put more of than anything else, because most of the time the market does not go anywhere. Even if it trends in a certain direction, you will typically find that it trends within certain barriers. And Australia is a great market for this, especially now that the rates are higher, options premiums are higher, risk-free rate forms a part of all investment instruments, including options. So it's a much more favorable time for options traders now than it was at any point in time over the last 10 years. And the R and Condor will basically pay you more premium now, plus you've got extra implied volatility, thus widening the amount of premium that you're getting for selling in the market. And it's an extremely common strategy. It's a lot of the American stuff, if you ever follow it, will go and tell you that you shouldn't do R and Condors, you should do short straddles and strangles. And I'll argue all day long with that. Yeah, you end up receiving less benefit upfront. You're paying for stuff, you're paying for your insurance with an R and Condor in case the market goes rapidly against you in either direction, but you get to sleep at night. And that's, having not slept for a long period of time while managing positions, that's something that just does not appeal to me anymore. So when you're trading an R and Condor, you want the market to move not a lot. So if it moves a little bit, you will win. Volatility will drop. You will lose if the market moves a lot, or volatility increases with a G there. Good to know that we can still spell. Then essentially your setup is the combination of two lids. Interestingly enough, they're two sold spreads, essentially 4 legs, or you can think about it as you're selling putting a call around the levels that you want it to not go, and then you're buying outside of that. When you want to trade this when IV rank is high, so preferably above 50, and you want the stock to not be trending, so something unexpected. Earnings season is a very good period to look at doing R and Condors. We did a whole heap of these during last earnings season. We'll do it again in the next one, in the major one. Although they basically either go really wrong or they end up being a really nice trade. You just need to make sure that you're on it and getting out, and yeah, don't go into stuff that's super unexpected. R and Condors, a slightly more difficult strategy, and that's because if you're setting it up yourself, you've got a bunch of things to worry about. In our case, just go into the strategy screen and type an iron into the screen, and it'll just pop up, and it pre-populates at the predefined strikes. Also, if there's a trade idea out with an R and Condor, just click it and it's there, and you can adjust it if you want to. The risk reward is limited to the premium that you've received, so the maximum profit is going to be the amount of premium you've received up front. That typically will go towards paying your margin as well. So you will mostly receive your cash for the R and Condor after it's expired, unless you've got stock. So if you've got some stock and you've lodged as collateral, then you get to receive the cash straight away and earn interest on it. The loss is the difference between strikes. Depending on how far the distance of the strikes is on the sold side is, less the amount of credit that you've received. Go in there. You can go under sideways and look at all the strategies, or just go, as soon as you get into the cookbook, just type in IR and it'll pop up, and you can go in and trade it. You kind of see this is those OCBA, but you can see probability of profit's pretty high. Out of default, you can see sort of 57, 58, and we keep them a little bit shorter than, a little bit less wide than globally. We sort of found that it's better to have a lower chance of being successful, but being more right, collecting more premium out of the trades consistently. And you can sort of see the odds are going to be slightly less than what your maximum loss is. Okay, so here's an example of an iron condor. Market's trading between 7,300 and 7,700. Basically, if you're of the view that the market's going to be trendless, your two options are an iron condor or a sold spread. And basically, when you're entering into an iron condor, it's a combination of two sold spreads. So if, let's say, you think that the market isn't going to go above 7,700 and you're taking that view, you're selling a 7,700 call and potentially buying, let's say, at 7,750, making the assumption that if it goes above 7,750, it's a breakout. I don't want to be a part of it anymore. So that's sort of your inbuilt stop loss. On your downside, you get to pick. If you take the view that it's going to be it's going to be relatively symmetrical. So call it about 100 points lower, 7,500 roughly. You could sell a 7,500 put and a 7,450 put. So when you click iron condor, that's kind of the trade that you're going to create. If you're of the view that I want to be looking at 7,300 resist as a support level, my general suggestion is just do the top part of that and wait for the market to come down and re-enter into a sold spread there, just because you're not going to get the kind of premium that you'd be looking for. The risk reward on that trade alone is going to be somewhat questionable. If, however, the stock is trading, the underlying index in this case is trading at 7,500, then putting an iron condor 7,700, 7,300 is a very in light of this chart, is a relatively safe strategy. We did a lot of work with iron condors, and we did a lot of work with the lit longs and the back testing, but we did a lot of work with, we had a quant who came in to run an extended amount of simulations with iron condors, and we ended up finding some really interesting things. We actually ended up tossing out things like RSI because we thought that it was very valuable to our trading. It turns out it really isn't. In fact, it was actually, if you were going to use RSI, we found that if you used it in a completely opposite way for what it was designed to do, then it would be, you would actually make more money. So we thought it was an anomaly. We dropped it, and we ended up coming up with this system that had 5 or 6 different triggers in between, and it actually adapts as the market changes. And so we used to talk about, kind of this AI built trading system, and everyone was always thinking it was crazy. What is this AI thing coming from the future? But basically, the trading system for iron condors, when it comes through, when those trade ideas come through, they are actually powered by learning from the market and getting the feedback from the market based on continuously improving the conditions for your trading. So thus, it's a little bit harder to explain how that strategy comes up. At a high level, what we found is that the things that are most important, as we sort of expected, is price, moving averages, where those moving averages are versus price. So it's been a sort of sudden breakout. Implied volatility is the number one most important factor. And then we sort of found that ADX is actually much better than what we probably expected initially, and thus it became a part of a lot of our trading systems. But we did find, so essentially we said, if we do an iron condor every single day of 2 or 3 expiries, what's going to look like? It turned out to be that there is sort of those 4 or 5 things that are very valuable to running. So when we get a trade idea that pops up, like this Dexus that popped up a little while ago, you can sort of see all of the different parameters that came through it. We have a bronze, silver, gold rating based on how much has come through in terms of the criteria that we were looking for, and whether there's an edge with volatility, blah, blah, blah. We then populate that, and you can just see that on the dashboard. So this is a DEXIS trade that popped up. Basically, taking that as an example, market was in between the two moving averages, which is one of those things that's either in between or it's really far away. Both of those are really good indicators. Basically, there was a condensing of the 50-day and 200-day moving average. I'm not actually sure where it ended up, by the way. Probably still a live trade, I would think. But the 725, 775 spread, and that based on our numbers, that probably we don't have a probability of profit there yet, but basically you'd assume that the market would be giving that a probability of profit of probably 55% or so. In reality, our numbers, bronze really puts it into a 70 to 80% chance of being profitable. So you get that edge from the market, from all of that lining up. So thus it became a trade idea. So when you're trading your iron condors, by default, if you're just trading a standard iron condor, you will have a 68% chance of getting it right. And that's because the markets can either, it can go up and go down at the same time. So we found that the best time to trade is around that, where that, it probably needs to be slightly adjusted, but basically where that black, this thing is called a probability cone. And that gives you just a standard deviation move of a price over a given point in time into the future. And you'll see that the likelihood of, or the uncertainty of an iron condor over time, it's most uncertain in those 45 days that I keep talking about. And so as a result, trading too much into the being very close to the future, you end up typically getting a lot of time decay, but also a lot of uncertainty. You can get an unexpected event, whatever might happen over a given day. So we found that the optimal is to have a relatively tight spread, and to try and take that from 68% down to a little bit lower. But we found that because you're bringing in the sold legs closer, you get a little bit more premium for it. So if you want to find out more about that, let me know. We probably should run a whole session on this, see if we can dig up those findings, and we really need to spend a bit of time refreshing it once we get a few more things in the platform. But basically, look, we've sort of covered a fair few things, but you've got your lit longs, lit shorts on the breakouts. It's definitely a lit long type market at the moment. On the directional stuff, every time you're getting a pullback, you're getting much more sideways action. In our case, the most important thing is, regardless of what trading system you use, or whether you use ours, as a basis to go on and define it, you have to have a system in place. And basically, to go in and when you're going and trading the trading system, you have to make sure that you've got the tools in your arsenal to be able to trade in any market, and you want to have the numbers behind you. So that's sort of why we've got the trade ideas. We know that these things work. And most importantly, we know that these work because the majority of the market will typically, majority of the retail market in particular, will go in and do the complete opposite. So you want to be able to go in and take a set of principles. You want to be able to trade that in any market. You want to be making only small changes. And most importantly, you use a trading system to get away from the emotional attachment to being either overly right or overly wrong. And for those of you that have traded a fair bit or have been in markets for a fair bit, you'll know exactly what I mean. So with our platform, I know I think big batch of you, I think, are already on the platform. But for those that are not and haven't seen it, we've by far got the best platform in the market. This is our third go of building retail trading platforms. So we're really proud of what we've done thus far, and there's a lot more coming into here. But with the platform, you can place combination trades straight from the screen. There's a whole heap of protections in place to make sure that you don't get it wrong. You can't trade something that's outside of market. You won't get sort of cancellations. You won't all of that kind of the crazy stuff that happens with ASX cannot happen through our platform. There's a whole heap of analytics, valuations. You get all of the information you need to go on and make a decision on a trade. There is a whole scanner. This thing is really cool. Definitely check it out. Basically, it allows you to go in and add any set of filters, price or indicators. So you can go indicators over indicators. You can go in and create your own sets of filters and see stocks moving in and out. We still yet to create push notifications on the back of stocks entering into your filters. That's something that we're going to be working on very soon, but that's going to be really, really awesome once that's there. But at the moment, you can have that in the background, and you can see stocks matching up a whole heap of separate criteria, depending again on what your trading system is. You can adjust that, and if you need other indicators, just let us know. We've got access to all of them. And then the trade ideas, and trade ideas are optional at the moment. Everyone gets them, but or the majority of them, I should say. The trade ideas is something that we see trade ideas from us. There's also other advisors that are now coming into the platform and placing their trade ideas based on the market. We're really creating a much more broader community around trade ideas in the platform, and you'll be able to subscribe to different people as you choose, inclusive of ourselves. But all of our trade ideas that pop up, they're in there. When you go and get a trial, you'll see that it's in the account, so you can just click and trade and place it on a simulated account. If you've got a real account as well. Ask Blake nicely for some discounts, and you might be able to throw some in. So if you need access, let us know. If you need access to the trading platform, I'm sure just sign up to Volatility and ask and chat to Blake in the chat, or ask him, or just type in yes or whatever, and we can totally provide that. We've got a bunch of events coming up. I'm working on something super cool, which will hopefully see us do a lot more content on any given week. This is sort of a thing to watch out for, but I think we're about to build something really, really exciting. Part of this is really going to be community driven. So we had the feedback from clients some that are trading with us, some that are looking to come to trade with us, that one thing that they really want to see a lot more of is that premium community of traders. So we're going to be working on that. That's going to be relatively soon, hopefully. It depends how many distractions I have between now and then, but basically it'll be chat and a lot more live content, not only just from us, but also other industry experts in the space. So that'll be part of inbuilt into the platform. We won't be using all these. We've sort of used all the different possible webcast providers, webinar providers over the years, and all of them have been somewhat disappointing in one way or another. So it'll be all kind of built into the platform, which will be really cool. But that's really cool. Anyway, but other than that, guys, we've run through a whole heap of information. I hope you got a lot of value out of that. If you've got any questions, obviously let us know. If you've got any feedback, definitely let us know. If you've got some themes that you want us to talk about in future sessions, let us know. And otherwise, I hope that you found this time valuable. Again, I value that you've come through and joined us in the session, and hope to see you on the next one. Thank you all very much. And John, before I do run, so just the question was, I would like former platform style lit and Iron Condor scans added. The former platform style was sort of, we had like this screener that I think you're talking about. There was one part of that was really cool, which was sort of that box of whiskers, which I definitely should bring back. The downside to that was that it didn't have all of the indicators built in, and so you didn't have the kind of the ability to go on and filter quite as effectively as, say, what our current filtering capability is. But I think that if you're sort of talking about that box and whisker things, which show you where the 50-day, 200-day moving averages are, plus then where the price is versus that, I think we should definitely look at bringing that back, because that was super cool. So maybe like an alternate view on the watch list, because that was relatively easy to put together. Plus, it adds a lot of value in terms of watching where things are approaching. So I'll add that to our list. But yes, anyway, other than that, make a note of that. Other than that, thank you very much, guys, for the session. I will catch you very, very soon.